Welcome to the weekly update. Well, we'll go over the action in the market for October 10th through the 14th, and then we'll see how things look for the week of October 17th through the 21st. And it was a pretty wild week. Unfortunately, not an awful lot was settled. We're still pretty much at a tipping point right now. We could, in a lot of ways, justify the market going up from here, even though technically that's not looking possible right now. All of our charts are still pointing down. But there's some other things like we're at support. There's some historical scaling or trends or seasonality things that could happen that could help the market go higher. But there's also real justification for things to go lower as well. So let's go back and talk about what happened. So on Monday, we did not get off to a very positive start because if you're familiar with Jamie Dimon, he's the CEO of JP Morgan Chase. And you don't get to be where he's at by not knowing what you're talking about. He said that he thinks the economy will be in a recession within the next 6 to 9 months. Now, some people think we're in a recession right now. I mean, you have to ask yourself, in your personal situation, am I in a recession right now? Maybe you're doing okay and you're getting by. Maybe you're really struggling right now. And there's this seems to be liquid definition of just what a recession is. That's mainly because the employment situation is still holding up really well right now. So they're using that as justification. And who wants to admit we're in a recession less than a month before a midterm election, if you're already in office? Also, in addition to that, he said that the market could easily fall another 20% if there's what we call a hard landing. Now, a soft landing would be that the Fed raises interest rates and just at the right time, they stop doing that. They start to cut rates without doing a lot of damage to the economy. Well, some people might argue that happened in 1994. I don't necessarily agree with that. I think a soft landing is pretty much impossible. The economy is so big. There's so many variables. There's so many things that can get out of whack with each other that something's going to be damaged along the way. But at least that's what the Fed tries to shoot for. The only thing they're shooting for right now is to try to get inflation under control. Another thing that happened is the International Monetary Fund, or IMF, they cut their global growth forecast. It had been at 2.9%. They cut it to 2.7%. That's not very positive. There's also some new cases coming out in China of COVID. And so they're replacing and renewing a lot of the restrictions. It doesn't seem to be as stringent as before. For those of you that don't know, that don't watch my daily videos, one of the things that I do is I teach English. You can tell by the way I talk. I teach English to Chinese children. And so I get some firsthand knowledge about what's going on. I do that online. And so I'm able to ask about what's going on, and different cities are acting in different ways. Some are pretty strict right now. Some it's like, what? There's restrictions again? Well, we didn't even know about that. So it just depends on what area folks are in. Also, the administration indicated that there will be consequences for Saudi Arabia following the agreement to cut their oil production. If you remember from last week's video and last week's news, Saudi Arabia came out and said they're going to cut production by 2 million barrels a day. Well, they didn't like that very much in Washington, D.C. And they said whatever the consequences are, they will be severe. And it's kind of open-ended. We don't really know what that means right now, but that probably is not going to help U.S.-Saudi relations for the time being. Another thing that is not positive is Russia increased their missile attacks on Ukrainian cities. That's never a good thing. They're really stepping up the pace in a lot of areas. That could also escalate at any time. Then on Thursday, the big report that they were waiting for all week came out, and it showed that CPI was up 8.2% on a year-over-year basis. The last time we got this report, it was up 8.3%. So it actually ticked down a little bit. And this is what the politicians will grab onto and say, well, it actually decreased a 0.1%. Well, big deal. All right. The core one is really the important one as far as inflation. If you take out food and energy, we were up 6.6%. The last time we got this report, we were up 6.3%. So that's actually going up. And this is the highest level since 1982 for the core rate. And I'm not big into these. Yeah, the first time we've been at this number since 1973, because we don't know the context. Now, if you were growing up during that time, yeah, there's some similarities between now and 1982, but there's so many different things going on. It's really difficult to make a comparison of that, but it makes for easy financial reporting. After the CPI came out, stocks fell and they fell hard and they were going down fast. In fact, they ended up making a new low in the S&P at 3491.58. But an interesting thing happened. We hit the 50% Fibonacci retracement level from the COVID low to the all-time high. And man, did things turn around. And we saw a powerful rally after that. Things just reversed and went up much, much higher. A lot of that was computer driven. About 80% of all the trading that happens every day is not even people. It's computer driven algorithms that do all these things. Well, a lot of people programmed this into their program, their application, to say, if you hit this level, buy, buy, buy. Well, you had a whole lot of computers doing that all at the same time and a lot of people doing that. And we really reversed. And this is what's really interesting to me. We were down about 2.5% or so. We ended up being up over 2.5%. We had a 6% intraday move. That is just massive for the S&P to have that big of a movement right within the one day. If you followed the day before on Wednesday, we were just inching along sideways, barely going anywhere. And then Thursday, we were off to the races, first to the downside and then to the upside. Some additional things in the UK is really having some trouble right now. Their bonds are called gilts. I don't know. Are they guilty for borrowing money? I don't know why they come up with that name. But the prime minister there, who's not really doing all that great right now, she said that she might scale back on her fiscal stimulus plan. Okay, the market liked that. All right. Also, they fired their finance minister. Okay, that sounded all right. But then on Friday, the Bank of England stopped doing their version of quantitative easing, where they were going into the market and buying these gilts. And now, as we hit the weekend, we don't really know what Monday is going to be like. There's a lot of uncertainty in the UK, and that could feed over into the EU. That could also feed into the US. That's kind of another focal point right now. We just want to see how things play out. There was no follow through buying on Friday. The S&P, we got up to 3712. And then that was resistance. It was a 20 period moving average level. And it just hit that level. We got to the 3,700 level and then just started tanking down below that. And this is while the gilts or the bonds in the UK were going up. There was some earnings reports that came out on Friday. JP Morgan, Citigroup, Wells Fargo, United Health, they all came out with better than expected reports, but that really didn't help all that much. Then we also had retail sales. They were flat on a month over month basis. If you take out automobiles, they were up just 0.1%. So we're seeing a lessening of the retail sales happening. And that's a huge part of the US economy. People just can't afford to buy things right now. Okay. So for the week, the Dow was down 1.55%. Man, you never know it by the roller coaster ride that we took, especially Thursday and Friday. Volume was above average. The technicals were still negative overall, and I'll go through the charts and kind of show you how that's working out. We're getting to some extreme negative readings. We're also seeing a lot of that on the daily charts, but technically we're still just not looking all that good. Inflation and interest rates continue to be the real fixation. We've got the whole list of geopolitical concerns. The ones that I mentioned just a moment ago, those are still going on. We have the issues in China that could feed over into the supply chain. Oil seems to be, well, it fell a little bit and it seems to be behaving. And then earnings, we're going to start coming into the real meat of earnings season. And then all this stuff going on in the UK right now. So there's a lot for the markets to try to take in these days. Our trend is negative and it's getting stronger. And I'll show you that chart. So here's the intraday chart. Here's Monday, kind of down, not all that much. Tuesday, we gapped lower, finished higher. Things were looking a little better. but then we started to really go sideways and then drop. Here was the yawner day on Wednesday where everything just went sideways. The FOMC meeting minutes also came out this day, but there was really nothing new other than what the Fed's already been saying, that they're going to try to tackle inflation. Here's Thursday. This is when we gapped lower. We gapped down to S3, which doesn't happen very much. And then we hit this low right down here at about 3,500. And this is when everything kicked into gear and just started screaming higher. We jetted up to R3. We almost made it up to R4, which I have to add that on the chart itself. And then it looked like, okay, we're off to the races on Friday. We're going to really keep going and build on Thursday's gains. Well, for the first 10 minutes, it looked that way. And then within 10 minutes, we just started going down. We ended up going down below the daily pivot and then closing at the low on Friday. So if you had to take your seasick pills on Thursday and Friday. For the week, the Dow was down 1.2%, actually up 1.2%. And that's the interesting thing. When we were going higher, it was the Dow that was leading things. When we were going up, value was outperforming growth. I'm not quite sure what to make of that right now, but that's just what I noticed as we were going up on Thursday. The NASDAQ was down 3.1%, the S&P down 1.6%, and the small caps were down 1.2%. Here's what we look like for the week, where the Dow is actually up with the rest of the indexes being down overall. And this is how they fared since the S&P 500 hit its all-time high back in January. All right, the sectors for the week. Discretionary got hammered, tech got hammered, utilities, real estate, blah, blah, blah. It's like 8 out of 11 sectors ended up down. The sectors that were up were healthcare and staples. Those are more the value plays. And then this is how they performed over the week. The sectors that were positive and then the sectors that were negative. And this just counts the 5 trading days of last week. It doesn't go from Friday to Friday. Current market valuation still has us at fairly valued, and this needle has been slowly inching over more towards the middle as the market has been coming down. And this is our aggregate score. We are coming back down to this black dashed line, which is the midpoint of things. So the yield curve model, we are now overvalued because we have gone slightly above this yellow dashed line, which is at +1 standard deviation. So that's a change that just happened. We're fairly valued with the Buffett indicator. This compares stock prices with GDP, and we're still below this yellow line here. So we're not necessarily extreme when it comes to the historical trend line. The PE model that we use is also fairly valued. This looks back using the CAPE version. Now, I have another chart that suggests that we're still overvalued at this point. But if you look forward, we're fairly valued. So can you see why the markets are a little confused right now? And here's the interest rate model, which is showing that we're fairly valued. We just dropped slightly below the midpoint historical trend line there. Margin debt, this hasn't been updated now since August 31st, and this shows that we're undervalued. And the mean reversion model, this is how far away are we getting from the mean or what the price should be for the S&P 500. And we are really coming down close to this historic trend line for this particular indicator. So we are fairly valued. Looking at sentiment, as of Friday's close, we are back into extreme fear territory. We almost got out of it. We got up to 24 after Thursday. We dropped back down to 21 on Friday. And here's the historical chart. This could suggest when fear gets really extreme, we use that as a contrary indicator, and sometimes that will give some support to the market. Another thing, the active asset manager survey that comes out once a week, they are now extreme negative again. And even though these are professionals, they're human too, and they use their emotions, and they're getting extreme negative currently. And this came out on October 12th, and this was for the previous week. So there's a little bit of lag in this particular indicator, but we can still use it to see how the markets are looking. Another thing, and I feel sorry for these folks, the RIDEX bear bull ratio, there's a couple day lag in this, but as you watch this thing going up and down, it's like the people that were doing this, that get into the bullish Ridex mutual funds or the bearish Ridex mutual funds, it's like they're doing the exact wrong thing at the exact wrong time. If we have a down day, they get into the bearish fund, and then we have an up day. If we have an up day, they get into the bullish fund, and then we have a down day. So these folks are really struggling right now, but they're starting to get a little extreme with how they're feeling about things. We also had the latest reading of the American Association for Individual Investors. They are also extremely pessimistic, but we've been camped down here for a little while. When it gets to an extreme negative reading, we like to use that as a contrary indicator that may give some support to the market going up. We also had the consumer sentiment. The preliminary report came out on Friday at 58.6. We compare this to the 2-year yield, where there's still a really big gap between the two. They have a tendency to move in the same direction, and they have a tendency, even though they're on different scales, to not get all that far apart from each other. And we're just way out of line right now. Another thing, looking at CPI, we were given the number that is based on how they calculate it now. If you go back to how they calculated things in 1990, we would be at about 13, 14%. That's the blue line up here. Now, that's not the bad news. If you go back to how we calculated it in 1980, we would be at 17%, 16, 17% right now. That's not very good. See how they manipulate things to change it around so it doesn't look so bad? Yes, and this is thanks to shadowstats.com. If you want to go check that out. As far as the GDP now, this is forecasting what GDP will be. They're still saying that we'll have positive GDP in the third quarter. Also, looking at the spread between risky bonds and not as risky bonds, it's actually ticked down just slightly in the latest reading. We're getting a little close here. When you look at the National Financial Conditions Index, as long as we're below this black line, we're okay. But if we dart above that, that means we're having some problems. We're getting close, but we're not above that black line, at least yet. Also, some Isabel net charts is just showing they've seen 35 weeks of outflows in European stocks. Even though this is coming back up, it's still negative overall if you look inside this red circle. Another one is just showing the insider transaction ratio. This is legal transactions. These are like the president, the CEO, people that own 10% or more of a company. They have to report when they're buying or selling stock. Right now, it's giving us a bullish signal when it gets down really low the way it is now. Another thing is the real retail and food services sales. Real just means they're taking into account inflation in this. And what they're pretty much saying is, you notice right before we went into a recession back in, late 2001 into 2002, it's just saying that this really leveled off. And the same thing right before the financial crisis, this red line really leveled off. Well, it leveled off right before the COVID plunge. Well, can you say that this is leveling off now? I don't know. It's pretty subjective, but this is the way things have played out in the past. What's the terminal rate? They keep raising that now. What's the rate going to be when the Fed finally stops raising interest rates? Right now, they're saying it's going to be 4.89%, and that it continues to go up. And then the 60-40, where you have 60% of your portfolio in stocks and 40%. How are you performing these days? Well, it's the worst year-to-date return in the past 100 years. So if you were investing 100 years ago, you were doing better than you are now. And you can see here's this red line right down here. The average is about 9% overall. So people are really suffering right now. Also, earnings sentiment. How are people feeling about earnings? Well, you have the S&P 500. That's the dark blue line. It's going down. Stocks, that's Europe. That's going down. That's the light blue line. And it's actually ticking up just a little bit. Topics is the gray line. That's Japan. That's going down, but it's still positive. And then emerging markets is the light blue line in here. And that's, where is that? It's hard to tell the difference on some of these. Oh, I guess that's here at the bottom, down here. It's actually coming up, but it's still negative overall. All these crazy blue colors can really confuse you. I'm finding this chart a little hard to interpret because I don't really know what this light blue line means here. But here's the CPI less the forecast median. And it just says that the headline number is consistently beating expectations since we started to see inflation really going up. And then this is the CPI, the dark blue line. What is this light blue line? I don't know. They don't tell about it in here. So I'm not really sure what, could that be the core rate? Possibly. I'm just guessing at that one. Then from FactSet, it says the S&P is likely to report earnings growth of 6 to 7% for the third quarter. As we're starting to see earnings coming out now, even though it's positive and they're growing, it's really come down based on what we've been seeing in the past. And that's just because we're hitting more difficult economic times. Also, here's the S&P earnings season update as of Friday. This is just showing the S&P earnings that are above, in line, or below estimates. If they're below, they're in this maroon area. If they're in line, that means they're yellow. And I'm not seeing really any, and this is all the different sectors right in here. And if they're above, then they get a green. So we're seeing some areas that are doing okay, and we haven't really received anything for the other sectors yet. This is other charts probably more helpful, where we look at the earnings growth for the third quarter. It's going down overall. All right, let's look at the VIX. It's getting to a pretty high level, both based on a closing basis and on the bar chart, but it's not necessarily spiking at a real high level. It could go higher than it is now. That just means fear could increase. The Ulcer Index, and we're back to the situation where the daily chart is really not helping us. The weekly chart, which that's what this is right here, this is more indicative of what we're feeling fear to be like, even in the daily videos. It's really starting to increase. And then I'm not going to talk about the possible positive scenarios because they're just until we really turn around and start to go up, they're just not relevant to what I talk about. Earnings right now on a historical basis, we are still overvalued. We have a 26.82 PE ratio looking back using the Shiller PE ratio, where we should be seeing about a 16 to 70%, or excuse me, reading of 16 or 17. So we're still overvalued on a historical basis. Now, looking forward, we're at 15.2 times earnings. That's more fairly valued. 10 is considered inexpensive. 15 is fairly valued. 20 is considered expensive. That's on a static number basis. And we're just a little bit above 15 right now. So this could justify the market actually going up from here. Or if we continue to fall, this forward PE ratio is probably going to fall as well. The Fed, and this is probably a little bit hard to read, as of Friday, there is a 97.2% chance that they're going to raise rates another 0.75% at their meeting on November 2nd. Yeah. Okay, here's the Fed balance sheet. They are still doing their easing, tapering, tampering, whatever you want to call it. The Fed balance sheet is still continuing to decline. Looking at breadth, man, we had a really explosive week the previous week. Well, we had a real down week this past week. And so the advanced decline line based on price and volume continues to fall. The advanced decline ratio starting to get extreme negative. New highs, new lows, haven't seen a real expansion of them overall because we're battling around in places where we've been not very long ago. So it can't create a new 52-week high or 52-week low. So when we are going down, we're setting more lows than we are highs. Accumulation distribution is negative. We're below a declining moving average. Our trend shows that the ADX is turning back up with the red line on top and advancing. So this is a strengthening negative trend on the weekly chart. Our Arun, not really telling us much, but it is pretty extreme negative, right? It's down as low as it can go right now. The mass index, not helping us. Long term, here's the daily chart first. This was a pretty significant support level. We ended up bouncing below it to come back up, bouncing below it, come back up. Well, we now are below that support level on the daily chart, and we're near the lower end of the mid range of the trend channel. Right now, the pivot points, we still have a ways to fall to get down to S2, which is at about 32.66. That's on the monthly pivot points. We are in a negative trend with the 50-period simple moving average. The long-term trend is down and declining. Bullish percent index, after giving us a pretty extreme negative reading, is trying to bounce, but it needs to come back above 30 for it to turn more positive. The Chaikin oscillator, we're getting extreme negative with this indicator. Chaikin money flow showing weakness. The force index is declining. McClellan oscillator, after giving an extreme negative reading, has actually bounced up. That's interesting. Also, the summation index based on price is extreme negative, and based on volume extreme negative, and you can see it's bouncing up a little bit. We see this on the daily chart sometimes, where volume will sometimes lead price. Right now, that's what's happening. So we may get some support from that. All of our oscillators continue to be down. Well, the KST's crossing over. They're pretty much negative across the board. We have a mix on the daily charts. The Swindlin trading oscillator, it was looking a little more positive a week ago. Well, now we're declining based on price and volume. The PMO, which I said just a moment ago, is declining. Based on price, we're extreme negative, and we're really dropping based on volume. And you could suggest that maybe we're getting to extreme negative with that as well. The PMOs that are rising actually showed a little improvement. The buy signals are improving, so we're seeing a little bit internal strength here, which might give us some hope. Now let's see if we can see it followed through with price. And the percent of PMOs that are above zero was pretty much flat from a week ago. RSI continues to decline. Special K, still positive, but it is declining. Stoke RSI, extreme negative. Williams percent R, extreme negative. Vortex, the red line is on top and advancing, so that is negative. Ultimate oscillator ticked up just slightly right here. Money flow index is declining. Bollinger Band's not giving us an extreme reading with the percent B measurement right now. The KST, it's probably going to cross over negative. It takes a lot for this thing to move and change. The PPO continues to be negative. The percentage price oscillator, the rate of change going back 1 week, not necessarily extreme. Going back 50 weeks, yeah, we're looking pretty extreme. We're getting down to the COVID lows. And we're seeing this also on the daily chart. So this could be used as a contrary indicator and possibly give the market some support. Copic curve not helping us on the weekly chart. We're still working off a signal on the daily charts. Here's probably the most important chart. This is a weekly chart of the S&P showing the COVID low to the all-time high. Right here was the 50% retracement. That's where we bounced up out of. We bounced back up. We actually broke below the 200-week moving average. We're just a little bit below that now. Can we stay above this 50% retracement? Can we get back above the 200-week moving average? That would be important. If we don't, then things could turn a lot, especially if we end up closing below this 50% retracement. That's pretty much going to change everything. Our charts, we're looking negative with the Heikin Ashi. We're negative with the Kegi. We're negative with the Renko, and we're negative with the EASA movement. We have some new zeros drawn in the point and figure chart, and we're looking at a double bottom breakdown, which happened on Monday. All right, we're looking at a 3-line break chart that is much more negative than it had been. The Elder's Impulse, negative for the S&P. SAR, negative with the dots on top. Okay, I keep hitting buttons in the market. Okay, and then here's the S&P, just showing how we've been declining. The mid caps have actually been holding up a little better, and their technical score is a little bit higher on the daily charts. We're still at support right here, where we've broken down through support on the S&P, and small caps, they're breaking just a little bit below, but the mid caps have really been holding up about the best. All stocks continue to be in a declining downtrend. Mid caps, declining downtrend. Small caps, declining downtrend. Dow, declining downtrend. The S&P, excuse me, the NASDAQ weekly, declining downtrend. NASDAQ 100, declining downtrend. Wilshire, declining downtrend. NYSE, you guessed it. FANG stocks had a bad week, down over almost 5.7%. They're breaking through support. ARC also really struggled, down 9.43% on the week. It looks like ARC gets a little bit of support, sees a few up days, only to give all of that back and then some. Software companies, the 30 biggest, they are in a downtrend. Here's Dow theory, looking how the Dow has been declining, the transports have been declining. Utilities have they were holding up, looking good, looked like the place you might want to be. Well, they've just been falling through the floor recently. Commodities still are in an uptrend, but we might be getting close to a death cross here. We were down over 3% on the week. Copper kind of hanging out where it has been overall. Gold, yeah, it's going to the moon, all right, but it might be doing a reverse trip. People just are sure that any day we have an update with gold, that's the beginning. Here it comes. We're breaking out, only to have it just fall back. And pretty much the same thing with silver. Oil, it actually fell on the week to 85.61. The dollar seems to mystify everybody. It keeps going up overall. But again, when you compare it to the British pound, the euro, the Japanese yen, it's the least crappy currency out there. And it's what most transactions are conducted in now. And so people need to find some safe place, and they're finding it in the dollar, and that's really pushing it up. There'll probably come a day when the dollar just goes in the toilet, but for right now, it's going to the moon. Looking at bonds, we see a continuation of the decline based on price with the bonds. Treasury yield is continuing to go up. On the 10-year, we closed above 4%. This just shows how the interest rates, this is a daily chart, and the blue line, that's the 2-year yield. That's where you're getting the best yield right now. But interest rates overall continue to advance. Here's a weekly chart showing that now the UK is in the lead because they've been just bumping up those rates, baby. And then the US is now in second place, followed by Germany. And then the red line is Japan. They have their own problems in that country that may develop at some point in the future. That's why their interest rates remain so low. Looking at some relative studies, oil, even though it declined on the week, is still doing the best so far in 2022. The dollar's in second place, where we have gold, stocks, and bonds are negative. The bond to stock ratio is slightly positive, but it did decline. Where if you look at the monthly chart, stocks continue to outperform bonds. Gold, which has been going down, and the dollar, which has been going up. That's why this line is just going down, down, down. And then here's gold to the S&P. Even though gold hasn't been doing well, it's been doing better than the S&P, although it has seen some recent weakness. Low volatility stocks, what people get into when we're running into trouble, they still continue to be in an overall uptrend. Growth to value. Growth has really been underperforming, so it's declining when compared to value. The NASDAQ 100, mainly growth compared to the S&P, also in a pretty significant downtrend. The S&P 100 compared to the S&P 500, it bounced up a little bit, but we're still in an overall downtrend. Discretionary, the things that you want to buy that make life interesting, compared with staples, the things that you have to have. Well, after seeing a little bit of a bounce back up, they're now showing some more weakness. Discretionary compared to staples. Energy, which is just going up compared to tech, which has been going down. So that's why we see a strong uptrend in this chart. Okay, so what's our outlook then for the coming week? Economically, we don't really have it. There's the Empire State report coming out on Monday. That pretty much just applies to New York. On Tuesday, we have industrial production and capacity utilization. We have the weekly report for the NAHB Housing Market Index. Wednesday, we get the Mortgage Applications Index. I think that's the weekly one. The NAHB one is monthly. Housing starts come out, and building permits, which can be a leading indicator. So we're going to start getting some more housing information. On Thursday, we have existing home sales and jobless claims and the leading economic index. And we don't have really anything on Friday that I could find. So the technicals, yeah, we're negative. The trend is clearly down. Are we going to see some support? Can that support level hold? Those are the questions that we're all asking right now, because the markets are fixated on inflation and interest rates. There's a list of geopolitical concerns: Russia, Ukraine, China, UK, any Fed speak that may come out at any point, and then anything that's not on this list that could quickly come to the forefront and cause the markets to freak out. So this is based on the daily video that I do. We are looking at a down scenario right now because of all the headwinds that the market is dealing with. Technically, on the daily charts, we are negative, but so far support is holding. We can't really go with the up scenario because our technicals are negative, but support is holding. Our scenarios, our setups, our rotation, those are all just on the back burner for now. We'll see if this week changes any of that. The technicals are so negative. You don't want to get in front of a moving freight train or try to catch a falling knife. Some people that try to do that really, the one time it might work, seems to justify the 100 other times you try it and it doesn't work. And then we can't really go sideways because the ADX is above 20 and it is negative. So thank you. Have a very good weekend. Enjoy the baseball playoffs if you're into that sort of thing. And I'll be preparing and posting the intermarket analysis video as soon as possible.